Welcome investors to another very interesting video. Today we are going to talk about a hidden and lesser known company which has quietly built a fully integrated industrial ecosystem over the years. And if the management executes its long-term roadmap properly, the future potential of this business can look completely different from what most people currently perceive. Because when most people hear the word steel, they immediately think of a cyclical commodity business. Prices fluctuate, margins fluctuate, coal prices rise, China dumping impacts realizations, and profits collapse during down cycles. And to a large extent, that understanding is correct. Steel is one of those industries where companies usually do not control pricing. The market controls pricing, which means most companies become price takers rather than price makers. But inside this same industry, there are a few companies that quietly build structural advantages over decades. Advantages that most investors initially fail to notice. Because in the steel industry, the companies that survive and compound over long periods are usually not the ones with the biggest size. They are usually the ones with the strongest cost structure, operational integration, and balance sheet discipline. And this is where today's company becomes interesting. Because this company is not just manufacturing steel. It controls almost the entire value chain, from captive iron ore mines, to beneficiation, to pellets, to sponge iron, to billets, to finished steel products, to captive power generation, and now even battery energy storage systems or BESS. So while most steel companies depend heavily on external raw materials, external power, and external intermediates, this company has spent years building an integrated industrial ecosystem. And this integration becomes extremely important during commodity cycles. But before we get to the company itself, let's first understand how the steel value chain actually works. Think of iron ore as raw grain, pellets are refined flour, sponge iron becomes prepared dough, steel billets become the shaped base, and finally rods, wires, structures, and coated products become the finished products sold into the market. Most companies participate in only one or two parts of this chain, but today's company operates almost across the entire chain through backward and forward integration. Backward integration means captive mines and captive power. Forward integration means moving toward higher value-added finished products instead of just selling raw materials. And this matters because captive ore economics are extremely powerful. The company's captive ore economics provide a major structural cost advantage, with FY26 captive ore landed cost at approximately 2,900 rupees per ton versus indicative market iron ore prices of approximately 6,200 rupees per ton. The company further enhances profitability through beneficiation and pelletization, with FY26 pellet realizations reaching approximately 9,724 rupees per ton, supported partly by higher grade pellets with superior Fe content that command premium pricing. Then on top of that, pellets themselves can command another premium of nearly 1,000 to 1,500 rupees per ton, depending on market conditions. Which means the company is monetizing not just mining, but beneficiation, pelletization, and processing efficiency across multiple stages. And interestingly, pellets are actually one of the most important profit engines of the business. The company's pellet capacity has now expanded from 2.7 million tons per annum to 4.7 million tons per annum after commissioning the new Pellet 2.0 plant. This is India's first natural gas-based great kiln pellet plant. Management selected this route because it reduced Capex by nearly 100 crore rupees and lower CO2 emissions by around 64%. And if exports revive in the future, management believes green pellets can potentially command another 1,000 to 1,500 rupees per ton premium. The company has also signed a 7-year gas supply MOU with GAIL, while pellet revenue itself can potentially scale from roughly 1,200 crore rupees toward 3,000 crore rupees over time. Now the beneficiation process itself is important. Raw ore first goes through crushing, washing, and magnetic separation, where Fe content is upgraded towards roughly 66%. This concentrate is then converted into pellets at temperatures above 1,200 degrees Celsius, improving thermal efficiency, gas flow, and furnace productivity. And this entire beneficiation to pellet chain is operating at very high utilization levels. Mining utilization itself remains around 92%, pellet utilization remains around 95%. Billet utilization remains around 96%, and sponge iron utilization has even crossed 100% in certain periods. Now, globally, many steelmakers are shifting toward gas-based DRI because it is cleaner. But management intentionally avoided making the core steel business heavily dependent on imported natural gas, because geopolitical disruptions can sharply increase gas prices. Instead, the company currently uses natural gas selectively for pellet operations, while maintaining coal-based DRI and future blast furnace integration for steelmaking. Currently, the company consumes roughly 0.5 to 0.6 million tons of imported RB1 coal annually, while overall coal consumption remains near 1 million tons. Imported coal costs also increased nearly 15 to 20% because of freight and currency fluctuations. Historically, the company operated through the DRI route, where pellets and coal enter rotary kilns and oxygen is removed from ore to create sponge iron. This sponge iron is then melted inside induction furnaces at temperatures near 1600 degrees Celsius, along with scrap and ferro alloys before being converted into billets. Ferro alloys improve hardness, tensile strength, and chemistry control, while impurities like sulfur and phosphorus are removed before continuous casting. Now at this point, many of you might already be realizing that this is not a normal steel company, because this is not just a company selling commodity steel. This is a deeply integrated industrial ecosystem. And the company we are talking about today is Godavari Power and Ispat Limited, or GPIL. And once you understand the business, the next real question becomes, where is GPIL actually heading over the next decade? Because honestly, the future roadmap is where things become even more interesting. GPIL is now trying to evolve from a cyclical commodity manufacturer into a more integrated industrial, materials and energy transition platform. And this brings us to one of the biggest future projects, the new integrated steel plant. This is not a small expansion. This is a major strategic shift. GPIL is building a 1 million tons per annum integrated steel plant through the blast furnace route, although environmental clearance has already been received for 2 times 1 million tons per annum capacity. Now here is something most investors miss at this point, because many people assume the blast furnace is just a bigger version of the DRI route, but it is actually a fundamentally different industrial logic. The existing Siltara plant reduces iron ore in solid state through rotary kilns. The output is sponge iron, which becomes billets, which get rolled into long products like wire rods, angles and HB wires. The blast furnace operates at nearly 1550 degrees, full smelting, and the liquid steel gets cast not just into billets but also into blooms. Blooms are what allow you to roll heavy structural steel. The large 600, 800, 1000 series beams used in transmission towers, railways and heavy infrastructure. Higher value, longer contracts, less spot price dependent. Yes, Capex is significantly higher, but the scale and quality of output simply cannot be matched by the DRI route. And separately, the cold rolling mill sits completely outside both these routes. It buys HRC externally and converts it into galvanized, ZAM coated and color coated flat products for white goods, solar structures and industrial applications. So GPIL is actually building 3 parallel downstream pathways: long products from DRI, heavy structural from the blast furnace and flat value added from the CRM, each with its own customer base, margin profile and end market. The first phase itself involves nearly 7,000 crore rupees capex funded through a 1-to-1 debt equity structure. The company has already acquired roughly 452 acres of land. Construction may begin around October 2026. Commissioning is expected around fiscal year 2029 and ramp up around fiscal year 30. The blast furnace route will produce nearly 1.1 to 1.2 million tons of hot metal annually using a mix of 50% pellets and 50% sinter from a new 1 million ton sinter plant. GPIL also internally fulfills nearly 25% of coking coal requirements and is building a 0.5 million ton non-recovery coke oven because India is gradually restricting coke imports. Importantly, management is not building this ISP to compete in low-end commodity steel. The focus is specifically on heavy structural steel, transmission structures, railway demand, and infrastructure-linked products. Customers can include EPC and infrastructure players like Adani, KEC, and L&T. GPIL has already received PGCIL approval for supplying steel billets to galvanized structure manufacturers involved in transmission projects. Now, another important project is a CRM or cold rolling mill. The CRM complex will have 0.7 million tons per annum capacity with roughly 900 crore rupees capex, funded partly through 550 to 600 crore rupees debt. Construction may begin around July 2026, while commissioning is targeted around March 2027. Interestingly, GPIL will not manufacture hot rolled coils itself. Management believes HRC manufacturing requires extremely large scale capex and behaves more like a commodity business. Instead, GPIL plans to procure HRC externally from players like Tata Steel, JSW, JSPL or NMDC and convert it into higher value products like color-coated steel, galvanized sheets and ZAM-coated products. Management has guided CRM EBITDA margins around 7 to 10%, with EBITDA potential near 4,000 to 5,000 rupees per ton. Now obviously these margins are lower than mining or pellet margins, but strategically CRM gives GPIL entry into white goods, solar structures, industrial fabrication, container applications and future BESS steel casings. And investors, we also find these small cap, micro cap and SME opportunities at an early stage through our research services, Emerging Titans and Tiny Titans. Emerging Titans is mainly built for mainboard small and mid cap companies, while Tiny Titans focuses purely on SME listed stocks. Across both services, you receive detailed research reports, entry and exit strategy, allocation guidance, and regular updates. So if you want to be part of our research community, you can visit valueeducator.com or check the link in the description. We follow our sprint strategy framework to discover such niche stocks with strong potential. Now let's get back to our video. This CRM captive integration for making steel casing for batteries directly connects to another major future opportunity: battery energy storage systems. Honestly, this is where the company's long-term narrative can completely change. Because commodity businesses are valued on cyclical earnings, while energy transition businesses are often valued on future optionality and long-duration demand visibility. India's total storage requirement by 2031 to 32 is projected around 411 gigawatt hours, out of which nearly 236 gigawatt hours may come from BESS, while pumped hydro contributes around 175 gigawatt hours. Two metrics to be noted: gigawatts equals power capacity, how fast energy can be delivered at a point in time, while gigawatt hours equals energy capacity, how much total energy can be stored. Current installed BESS capacity in India is still below 500 megawatt hours, while the tender pipeline itself is already around 92 gigawatt hours. The India BESS market could reach nearly $8.6 billion by 2031, while the broader India energy storage market may grow from around $7.8 billion in 2024 towards nearly $32 billion by 2030 at roughly 27% CAGR. Government targets also suggest India could move towards nearly 74 gigawatt BESS capacity by 2031 to 32. Now, importantly, GPIL is not trying to become a lithium chemistry manufacturer or a CATL-style upstream battery giant. Instead, GPIL is positioning itself as a midstream BESS assembler and systems integrator through its subsidiary GNEPL, meaning importing cells, assembling battery packs, integrating BMS, PCS, and EMS systems, and manufacturing complete containerized storage systems. The commercial BESS project itself targets 20 gigawatt hours capacity in Maharashtra at the Ore industrial zone. Capex for the project has gradually scaled from roughly 700 crore rupees at the initial 10 gigawatt hour stage toward nearly 1025 to 1400 crore rupees as capacity expands to 20 gigawatt hours. Alongside this expansion, around 310 crore rupees has already been incurred and nearly 112 acres of land have been acquired, with commissioning currently targeted around March 2027. GPIL has also entered into a supply agreement with EVE Power for grade 1 628 ampere hours LFP cells, while BOS systems come from Shanghai Shenny Roche Energy, and PCS suppliers include Fimmer India and Hope Wind. Management expects BESS EBITDA margins around 7 to 8%. Now, many people may ask, if pellet margins are already higher, then why invest in CRM and BESS where margins are lower? And the answer is because management is optimizing not just margins, but long-term positioning, revenue visibility, and valuation re-rating. Steel and pellet businesses are cyclical, but BESS can operate through utility contracts, renewable integration, frequency regulation, grid balancing, and long-duration storage projects. And if GPIL fully executes the 20 gigawatt hour target, the company alone could potentially address nearly 8 to 9% of India's projected BESS requirement. Now, along with BESS, GPIL is also aggressively expanding renewable infrastructure. Operational solar capacity is already around 165 megawatts. Another 125 megawatts is under development, and the eventual target is nearly 540 megawatts. Importantly, the company does not intend to sell surplus power externally. The strategy is fully captive consumption for mines, pellets, CRM, and ISP. This becomes economically attractive because electricity at the mines can cost nearly 11 rupees per unit from the grid, while captive solar projects can potentially generate around 24% IRR. GPIL also operates nearly 300 megawatts power infrastructure, including thermal, waste heat recovery, and solar. Waste heat recovery itself acts like a hidden EBITDA enhancer, because hot exhaust gases from rotary kilns are converted into electricity instead of being wasted. Now, another hidden integration layer is Ferro Alloys. Through subsidiaries like HFAL and AFAL, the company manufactures ferromanganese and silicomanganese used internally during steelmaking and also sold alongside. HFAL itself has around 61,500 tons per annum capacity, along with 20 megawatts thermal, 8.5 megawatts biomass, and 1.5 megawatts wind capacity. Captive power cost for ferroalloy production remains around 3.5 to 4 rupees per kilowatt hour compared to grid costs of 7 to 9 rupees. And this matters because ferroalloys are extremely power intensive products. HC ferromanganese can consume around 2800 to 3200 kilowatt hours per ton, silicomanganese roughly 4500 to 5800, and ferrosilicon nearly 8,700 to 9,500 kilowatt hours per ton. Currently, around 40% ferroalloy production is consumed internally, while 60% is sold externally. Now, another important point is exports. Historically, GPIL exported roughly 15 to 30% of pellet production to markets like Japan, Korea, and the Middle East. But today, exports are almost negligible. In FY25, total exports contributed only around 71.49 crore rupees, barely 2% of total turnover. Management also stated that pellet exports were almost nil for nearly 18 months, except for one vessel exported in January 2025. And interestingly, this is not necessarily a weakness. Domestic realizations themselves became nearly $15 to $20 per ton higher than export markets. Now, coming to the broader steel cycle. Global crude steel production currently stands around 1,886 million tons, while China alone contributes nearly 54% of global steel output versus only around 15% in 2000. This matters because whenever China enters overcapacity mode and starts export dumping, global steel prices collapse. And we already saw this during the brutal 2014 to 16 steel down cycle, when HRC prices crashed from nearly $700 per ton toward around $300 to $350 per ton. Many companies collapsed under leverage pressure. Bhushan Steel collapsed, Jaiswal Neco entered severe stress, Usha Martin exited steel operations. Even GPIL saw revenue decline nearly 30 to 35% and underwent restructuring. But the important lesson from that cycle was this: the companies that survived were usually the ones with stronger balance sheets and better integration. And this is where GPIL looks structurally stronger today, because of lower leverage, stronger captive integration, and better cost structure. Now, India itself remains a huge long-term steel opportunity. India produced roughly 144 million tons per annum steel in fiscal year 25, and capacity targets could move toward nearly 300 metric tons per annum by 2030. At the same time, India's per capita steel consumption remains only around 97 kilograms versus global average near 230 kilograms. Large infrastructure programs like PM Gati Shakti and the 111 lakh crore rupees National Infrastructure Pipeline directly support demand for GPIL's products. Currently, GPIL operates around 4.7 million tons per annum pellets, 0.65 million tons per annum DRI, 0.5 million tons per annum finished steel, 0.23 million tons per annum wire rods, and roughly 0.10 million tons per annum HB wires. GPIL already controls nearly 6% share of India's pellet capacity. Overall TAM across GPIL's businesses is estimated around 2 to 2.5 lakh crore rupees, while current TAM penetration remains only around 2 to 3%. Even after Vision 2031 expansion, implied TAM penetration may still remain only around 12 to 15%. Now, coming to peers, Lloyds currently operates with higher EBITDA margins, sometimes around 33%, mainly because it remains more mining heavy, where margins can structurally move toward 40 to 50% plus. GPIL, on the other hand, is more downstream integrated, meaning lower percentage margins but more diversified earning streams. The captive mine advantage becomes even more significant when we compare it with Shyam Metals, which operates at lower margins as they have to buy iron ore externally via a merchant. Now, coming to financials, FY26 EBITDA margins remained around 23%, while profit after tax margins stayed near 15%. FY26 sales stood at 5,381 crore rupees, while FY26 EBITDA stood around 1,253 crore rupees, while profit after tax remained around 802 crore rupees. Q4 EBITDA rose nearly 38% year-on-year and 91% QOQ toward roughly 439 crore rupees, while Q4 profit after tax moved toward around 280 crore rupees. FY26 EBITDA stood around 1,253 crore rupees, while PAT remained around 802 crore rupees. Q4 EBITDA rose nearly 38% and 91% QOQ toward roughly 439 crore rupees, while Q4 PAT moved toward around 280 crore rupees. Cash flow from operations increased nearly 27%, while cash balance stood around 837 crore rupees. Now let's come to Vision 2031. GPIL targets 30,000 crore rupees revenue, 5,000 crore rupees EBITDA, and 3,000 crore rupees profit after tax by 2031, meaning nearly 5 times revenue growth, 4 times EBITDA growth, and 3.5 times profit after tax growth from current levels. Management expects BESS alone to potentially contribute around 15,000 crore rupees, ISP around 6,000 to 7,000 crore rupees, CRM around 3,000 to 4,000 crore rupees, while pellets and steel contribute the remaining balance, meaning nearly 50% of future top line may come from BESS itself. Now, obviously risks are equally important. This remains a cyclical commodity-linked business. Chinese dumping can hurt realizations, coal prices remain volatile, CRM depends on external HRC procurement, and BESS still depends heavily on imported Chinese cells. At the same time, GPIL is also gradually expanding toward recycling and ESG-linked opportunities through investments like Jammu Pigments. So overall, if we step back and look at the bigger picture, GPIL is no longer merely a cyclical steel company. It is gradually evolving into an integrated materials platform with captive mines, pellets, steel making, renewable infrastructure, downstream products, and future BESS optionality. And honestly, this is where the real investment thesis exists. Because sometimes the market keeps valuing a business based on what it was, while management is quietly building what it can become over the next decade. We identify such small cap, micro cap, and SME companies early through our research services, Emerging Titans and Tiny Titans. Emerging Titans is mainly built for mainboard small and mid cap companies, while Tiny Titans focuses purely on SME listed stocks. Across both services, you receive detailed research reports, entry and exit strategy, allocation guidance, and regular updates. So if you want to be part of our research community, you can visit valueeducator.com or check the link in the description. We follow our sprint strategy framework to discover such niche stocks with strong potential. That's it for today's video. If you found this detailed breakdown useful, then like the video, subscribe to the channel, and comment below sprint if you like the detailed research. We will meet again next Saturday with another video at 11 AM.